Most people will never retire rich, not because they didn't earn enough, because they kept buying the wrong things. Here's the truth. Nobody in finance wants to say out loud, the average investor underperforms the market by about 1.5% every single year. Not because they're dumb, because they overcomplicate it. They chase hot stocks, pay high fees, and panic every time the market dips. Meanwhile, 3 simple Vanguard ETFs have been quietly building wealth for the people who figured this out. I'm Tony, and in this video, I'm going to show you exactly which 3 ETFs those are, what they've returned over the last 10 years, how much they cost you per year, and how to mix them based on how old you are right now. Stay until the end, because the allocation strategy I give you at the end is what most financial advisors charge hundreds of dollars per hour to explain. Let's get into it. Before I show you the 3 ETFs, I need you to understand one number that destroys most retail investors without them even realizing it. That number is the expense ratio. It's the annual fee a fund charges you just for holding it. Sounds small, usually looks like 0.5% or 1%. But over 30 years of investing, a 1% fee on a $100,000 portfolio doesn't cost you $1,000. It costs you over $90,000 in lost growth. That's not an exaggeration. That's compound interest working against you instead of for you. This is exactly why Vanguard built its reputation. Their ETFs charge almost nothing. We're talking 0.03% to 0.10% per year. Compare that to the average actively managed mutual fund at around 0.66%, and you start to see why people who just buy Vanguard ETFs and forget about them end up with more money than people who constantly trade and optimize. Keep that in mind as I walk you through each one. ETF number 1, VOO, Vanguard S&P 500 ETF. This is the foundation. If you own nothing else, you own this. VOO gives you ownership in 500 of the largest companies in America. We're talking Apple, Microsoft, Amazon, Nvidia, Alphabet. But here's what makes the S&P 500 genuinely brilliant and why it's not just a boring safe pick. The index is self-cleaning. Every quarter, a committee reviews the companies inside the index. Companies that are shrinking, losing relevance, or heading toward failure get removed. Companies that are growing, gaining market share, and becoming dominant get added. You don't have to make any decisions. The index does that for you, automatically. Think about what that means over time. 10 years ago, companies like Sears and some legacy energy firms were fading out of the index. Meanwhile, Tesla and Nvidia were growing into it. You didn't have to predict any of that. You just held VOO and let the process work. The expense ratio, 0.03%. That's $3 per year for every $10,000 you invest, almost free. The 10-year annualized return, approximately 13.1% per year as of early 2025. If you had put $10,000 into VOO 10 years ago and done absolutely nothing, you would have roughly $34,000 today. No research, no stock picks, no stress. Now, VOO is not perfect for everyone. If you're within 5 years of retirement and you're 100% in VOO, you have a problem. In 2022, VOO dropped about 18%. In 2008, the S&P 500 fell nearly 38%. If you're 62 years old and your entire savings drops 38%, that changes your retirement date dramatically. That's why you can't stop at one ETF. You need 2 more. ETF number 2, VGT, Vanguard Information Technology, ETF. If VOO is the engine, VGT is the nitro. VGT holds around 310 technology stocks, but it's heavily weighted toward the biggest winners. Its top holdings are Apple, Microsoft, and Nvidia. These 3 companies alone make up a massive portion of the fund. Why does concentration matter? Because in technology, the leaders don't just win a little, they win everything. Apple doesn't just sell some phones, it controls an ecosystem of over 2 billion active devices worldwide. Microsoft doesn't just sell software. It runs the cloud infrastructure that powers thousands of businesses. NVIDIA doesn't just make graphics cards, it makes the chips that train every major AI model in existence. VGT lets you own all of that in one single ticker. The expense ratio, 0.10%. So for every $10,000 invested, you pay $10 a year. Still extremely cheap for what you're getting. The 10-year annualized return, approximately 20.8% per year as of early 2025. Let's put that in real numbers. That same $10,000 you put into VOO, that became $34,000? In VGT, over the same period, it would have grown to roughly $65,000. Same starting amount, same time, dramatically different outcome. But I have to be straight with you here, especially if you're over 50. VGT is volatile. When markets get scared, tech sells off first. In 2022, while VOO dropped 18%, VGT dropped nearly 33%. That's 1/3 of your money gone in a single year. If you're close to retirement, you can't put everything here. VGT belongs in the growth portion of your portfolio. The money you don't need to touch for at least 7 to 10 years. So we have VOO as the stable base. We have VGT as the growth accelerator. Now we need the third piece, the one that actually pays you. ETF number 3, VIG, Vanguard Dividend Appreciation ETF. This one gets ignored a lot because it sounds boring. It shouldn't be. VIG holds companies that have increased their dividend every single year for at least 10 consecutive years in a row. Think about what that filter actually removes. Companies that are struggling don't raise dividends year after year. Companies that are burning cash don't either. What's left? Companies with strong balance sheets, consistent earnings, and management teams that are confident enough in the future to keep paying shareholders more every year. We're talking about names like Microsoft, United Health Group, JP Morgan Chase, and Visa. Companies with real pricing power and real cash flow. The expense ratio, 0.06%. Basically, zero. The 10-year annualized return, approximately 11.6% per year as of early 2025. Lower than VOO and VGT? Yes. But the reason you hold VIG isn't maximum return. It's stability and income. In a market crash, VIG historically drops less than the broader market. In 2022, while VOO fell 18% and VGT fell 33%, VIG dropped around 10%. That's a much softer landing. For someone in their 50s or 60s, that matters enormously. You're not just protecting your capital, you're also getting dividend income that grows every year, which helps replace your paycheck once you stop working. If you're listening there, comment with the time you are watching this. I'll like everyone who does it. Now, how do you actually mix these three? This is where most people get stuck, so I'm going to make it simple. Your allocation depends on one thing. How many years until you actually need this money? If you are 35 to 45 years old, time is your biggest asset. You can absorb short-term drops because you have decades of recovery ahead of you. Recommended allocation, 50% VOO, 40% VGT, 10% VIG. You're leaning into growth. The tech exposure is high because you have the runway to ride out volatility. If you are 45 to 55 years old, retirement is getting real. You still want growth, but a big drawdown now could actually affect your plan. Shift to 60% VOO, 20% VGT, 20% VIG. You're cutting tech exposure in half and doubling your position in dividend stability. If you are 55 and older, your job now is to protect what you've built while still growing it enough to beat inflation. Allocation: 50% VOO, 10% VGT, 40% VIG. You keep a small slice of tech to prevent inflation from eating your returns, but you lean heavily on quality dividend-paying companies to smooth out the ride. One more thing worth mentioning that most videos skip over: taxes. If you hold mutual funds in a regular brokerage account, many of them distribute capital gains at the end of the year, even if you didn't sell anything. You can get a tax bill just for holding the fund. ETFs are structured differently. With VOO, VGT, and VIG, you generally only pay capital gains tax when you decide to sell. If you're in your peak earning years and in a high tax bracket, this tax efficiency adds up to thousands of dollars over a decade. It's a real advantage that doesn't show up in the return numbers, but absolutely shows up in your final account balance. So to pull it all together, VOO for broad market exposure and stability, VGT for technology-driven growth, VIG for income, downside protection, and dividend growth over time. Set up automatic monthly contributions. Don't check your portfolio every week. Ignore the daily headlines. The people who build real wealth from the market are almost never the ones who trade the most. They're the ones who invest consistently, keep costs low, and let time do the work. If you want to see how the top fidelity ETFs stack up against these three, watch the next video. Just a reminder, I'm not a financial advisor. This video is for educational purposes only, and any results depends on your own decisions and actions.